Chapter 17, Exchange Rates and International Economic Policy. Exchange rates. When is exchange rates required? Let's say there are two countries, United States and India. In the chapter, it's United States and Europe, but I'm going to look at India, United States and India. So let's say these two countries wants to buy each other's goods and services. If the United States wants to buy goods from India, India wants rupees. And let's say India wants to buy United States goods and services, US would want dollars. So there's a mutual exchange, and so what happens is the United States says, hey, I will give you my dollars, you give me rupees, and vice versa. So that exchange between two countries, where there are different currencies, United States has a dollar currency, India has rupees, and so Europe would have euro, British currency, in Britain there will be pounds and things like that. So different countries will have different currencies. And so this exchange between these two countries is through this market called the foreign exchange market. Foreign exchange market is a set of dealers, and today it's a set of banks and multiple private dealers ready to give you a conversion from dollar to rupee. So they'll take your dollars and give you rupees if you want rupees in the United States, and it'll take rupees and give you dollars. So this foreign exchange market set of banks and dealers, they help you with this conversion. And there are two types of rates. There is a spot exchange rate, which is the current ongoing rate, which is right now, tell me if I want to spend 1,000 rupees worth of if I want to buy 1,000 rupees worth of goods, how many dollars do I need? So for that you need a spot exchange. The current price is the same. Forward exchange, basically a future price. So you can say, hey, I want to buy 1,000 rupees in that future period of time, and I want to buy it now. So then you can say, hey, in that period I'm going to buy it, so you will have exchange rates into the future. Those are forward exchange rates. The reason why there are these forward exchange rates, you can say, hey, look, I am bullish about the dollar, but I see the depreciation happening, so I can book the rupees now into the future. So that's where there is forward exchange rates. So now we know why exchange rates needed, because dollar, you cannot take dollar and go to India and buy things. You need to convert it to rupees and then buy things, right? So vice versa. So now let's take an example. Today, $1 equals 70 rupees, right? That's the exchange rate. How did we get to this exchange rate? We get to that, but that's the conversion rate. Say, hey, if $1 equals 70 rupees, let's say that is the rate today. Let's say a week from now, $1 becomes 80 rupees. $1 becomes 80 rupees. So the same dollar that got me 70 rupees today, if I would have waited, I would have gotten 80 rupees. In that case, what we see is that the dollar got stronger. Yeah, dollar got stronger. So when dollar got stronger, because see, initially it could get 70 rupees, now it's getting 80 rupees. So for the same dollar, if you get more rupees or the other currency, you say that the dollar became stronger, or you can say that the dollar fetches more rupees, or you can say the dollar appreciated, and vice versa. You can say the rupee got weaker. When the dollar appreciated, we can say the rupee got weaker, or the rupee depreciated, right? So that's what happens when a dollar becomes 80 from 70 to 80, right? So at that point, dollar became stronger, it appreciated, and rupee became weaker, it depreciated. Now let's look at the opposite example. A dollar fetches 70 rupees today, and a week from now it fetched 60 rupees. What happened? The same dollar just got weaker, right? It can only now fetch 60 rupees. So when the dollar gets weaker, the rupee gets stronger. So the rupee has appreciated. The rupee said the people in India now only need to spend 60 rupees to get the same dollar. Now before people in India had to give 80 rupees to just get $1, right? So the rupee got stronger. So now we understand what appreciation of a currency is and what depreciation of a currency is. So now let's look at the distinction between nominal exchange rate and real exchange rate. So nominal exchange rate is like whatever the current rate is, $1.70. But now let's look at this new concept called purchasing power, which will help us understand real exchange rate. So let's say today in the United States, for $1, you get the Big Mac burger. Let's say you get a burger, a simple burger for $1. The same burger, exactly the same. If you get in India for 70 rupees, and if the exchange rate is $1 equals 70 rupees, then whatever you got in the United States, the same good you got in the other country, in India, then the exchange rate is 1, right? Because nothing changed. You got the same good in two different countries. Your same dollar, if you'd have spent here, you got the burger, and you converted that to rupee and you got the same burger, then the real exchange rate is 1. But typically, the real exchange rate is never 1. It's either below 1 or above 1. Sometimes it is close to 1. So let's look at how is real exchange rate calculated. I gave you an example as to how you can think intuitively about real exchange rate. Real exchange rate is basically saying, hey, if I were to exchange, am I losing or am I gaining or am I par? Right? In this case, you are at par, same price. So now let's say if the same $1 burger in the United States costs you 140 rupees instead of 70 rupees, which was the case here. If that's the case, we calculate the real exchange rate as equals nominal exchange rate divided by the relative prices, which is the domestic price divided by the foreign price. So the nominal exchange rate today is also, let's say, $1 equals 70 rupees. My US, I have to pay $1, but in India, I pay 140 rupees. So my real exchange rate is 0.5. So it's less than 1, right? So the goods are cheaper in the United States, almost by 50%, right? So it's 0.5. So when real exchange rate is less than 1, domestic goods are cheaper. And when it's greater than 1, domestic goods are expensive, right? So goods are cheaper in the United States, and you can calculate the real exchange rate. It's basically relative prices. Domestic, which is the price that is your base price. United States would be the domestic price. Foreign would be the country which you are comparing. So now we know how to get to real exchange rate calculations, right? Why is this important? Because think about this. First of all, you will not be able to buy the same goods and services in two different countries that are exactly identical. There'll always be some difference. The quality might be different. You can't really compare the two as exactly the same. So there's going to be some differences. Also, there are certain things that don't move borders. Like it might be cheaper to get a haircut in India, but you can't have the same barber cut the hair for people in the United States. It just doesn't cross the border. So there are these things that are not movable. They're not transferable. Those non-transferable goods and services make this equation a little complicated. So real exchange rate typically doesn't stay at 1. It changes up and down based on your other factors that I talked about. So one other key piece is that the prices, remember from the previous chapters, prices are sticky, right? Because they change slowly. So if let's say the burger required 2 buns and then those buns became expensive in the United States, but it didn't in India, but they're not going to change the prices of the same burger overnight because overnight buns became expensive. It takes some time. So prices are sticky. And so when prices are sticky and if the exchange rate is volatile and it keeps changing, so let's say the dollar now instead of fetching 70 rupees fetches 80 rupees, right? If there is changes or volatility or appreciation or depreciation of a currency, it impacts the current country's import and exports. Let's see how, right? So if the dollar became from 70 rupees to 80 rupees, what happens? Think about this. The same dollar fetches more rupees, right? So for the people in the United States, it became cheaper to buy goods from India, right? Because let's say the buns got expensive in the US, but they are not expensive in India, so they're gonna start importing more. So the US imports will go up because the currency appreciated, the dollar appreciated from 70 to 80 rupees. So the imports in the United States will go up because it's cheaper. You can, for the same dollar, get more rupees, and the same rupees now fetches more buns. I'm gonna go get all the buns from India, right? But at the same time, my exports will go down because people in India, now for the same dollar goods that I was selling them, let's say I was selling them a Ford car, they have to shell out 80 rupees for every dollar. My prices of my car is not gonna go down because of this depreciation. So they were initially converting 70 rupees for every dollar of that car that they're buying from the United States. Now they have to give 80 rupees for the same dollar. So my exports are going to go down because the demand for my goods are going to go down. And exact opposite, right? So for US imports to go up, the India exports will go up because these exports in the other country will support the imports. And the exports going down, meaning the other country's import goes down. So these are cross-functionally connected. So here's why all of this is important. When your exchange rate fluctuates in a very volatile way, your imports, your exports are impacted in a major way, especially because prices are sticky. So that's the key intuition to build here. And this is and if we combine the sticky prices with this law of one price, so let's look at law of one price, then we can get to this theory of purchasing power parity. So we understand price stickiness and how it impacts the exchange rate. Now let's look at law of one price. So law of one price basically says if there were no barriers to capital flow between countries, and if say there were no tariffs between countries, so people could freely trade, and if there was no transportation costs, these are some assumptions, right? There's always going to be transportation costs between countries. But let's say there are no transportation costs, there are no barriers in terms of tariffs. So let's say if there are equal playing grounds, then the cost of goods for identical product, and I put an identical with a star, cost of goods for identical product will be same everywhere. So if I have to produce that burger in the United States, or if I produce that same burger in India, it should be the same price. So that's the law of one price, which basically says if there were no barriers, there's no high cost of transportation, then it'll take the same good can be built with the same price structure. And this is powerful. Think about this. If United States produces, let's say, the burger for $1, but the same burger can be produced in India for 10 cents, then the demand for United States burger will go down. And Indian burgers will go up, right? So you can just take burger as an example. It's perishable, so you can't use that, but let's imagine that burger was the only thing that was traded. So then, because people will not buy the burger from United States, or let's say the car, right? United States car, Ford, and then now let's say there's an equivalent car in India, then the demand for United States will go down, right? Because if the same good I can buy for cheaper, I'm going to start importing, right? So now that's law of one price. So wherever you get the cheapest goods, demand will go to that country, and it will keep going there. So then what happens? When I start importing more, my currency appreciates, right? If I have more imports, my currency appreciates, and so then what happens then is that eventually it balances out, right? So if my currency appreciates, then I'll be able to buy more of those goods, right? So now let's look at purchasing power parity. So what does purchasing power parity say? So in the long run, the exchange rate in the two countries, the exchange rate between the two countries will adjust to their relative price level. So that's the intuition of purchasing power parity. So if India, let's say the price level went up by 5% of a good because of, let's say, inflation, then, so let's say it became from $70 to $73, that burger, then my dollar would appreciate in terms of rupee by that same percentage, 5%. And it's combining these two. The intuition is that, hey, if I can buy something cheaper there, I'm going to go buy from there. And when I keep buying from there, my imports from that country will increase. And when my import increases, my exchange rate appreciates. So you see the connection? As the price level goes up in the foreign country, the exchange rate appreciates from the domestic to foreign country. So then, and it's all part of this log one price. It's trying to meet at the price that is the best price that's available out there. So, and this all assumes there's global free trade, that there's no tariffs, right? So that intuition that your currency appreciates if the foreign country price appreciates, or if there's inflation there, right? And that primarily happens with supply-demand characteristics that we saw. So now let's try to put all of this into a graph. So if on the y-axis, if we have the dollar assets, and on the x-axis is the dollar assets, on the y-axis we have the exchange rate, which is rupee over dollar. What is the exchange rate? And if we were to see this total supply, because let's say on a given point in time, United States has a fixed amount of assets. So one other way to think about exchange rates, right? This exchange rate is basically the price of domestic asset in exchange of foreign currency. When the United States tries to buy things from India, it's basically saying, hey, look, I'll give you some part of my country or some part of my equity or some part of my asset. It could be a bond, it could be an equity, it could be a bank deposit, whatever that is. I'm trying to sacrifice that so that I can get what you have, that burger, right? I'm going to try to give you my $1 in my bank account to give you that. So that's basically exchange rate. So that is this piece. So the supply is going to be fixed at a given point in time, because let's say if you combine all of United States dollars, right, all of United States assets, you can draw a straight line that says, hey, total bond, total equity, total bank deposits is this much in the United States. So that's the supply, right? And then if you see, you can draw 3 points. So that's the demand. This is the demand for dollar, and this is the supply for dollar. And there are 3 potential points where the demand for the dollar, meaning what everyone wants from United States, that's the demand for dollar. Like if everyone wants United States goods and services, the demand for dollar will keep going up, right? It will keep going up. So demand goes up. As demand goes up, so let's look at these 3 data points. So where demand meets the supply, that's the equilibrium, right? So if United States $500 are needed by everyone, and the United States is able to give those $500, then we are at equilibrium. But if, let's say, the demand for United States dollar is $100, so let's say this was $500. This is the total. United States is $500 worth of assets. But let's say at this point the demand for United States dollar is only 400, right? But the supply is 500. The supply is 500, but the demand is 400. What does that mean? People don't need 500 worth of United States dollar. They only need 400. So then what happens? Exchange rate falls, right? Exchange rate falls. So the dollar depreciates. This is depreciation. So this falling from A to B is because United States, the demand for United States dollar is only $400 worth of assets. But United States says, hey, I'm willing to give you 500 because I have that much to offer. So then the exchange rate falls. Similarly, if the United States dollars demand at this point says, hey, I want $600 worth of United States asset. Everyone wants to just buy United States assets because it's safer, it is the largest out there in terms of the country size, and so if let's say people want $600 worth of United States asset, but there's only 500, then what happens? The dollar appreciates, right? The dollar appreciates. It can now command more and more. So it goes from 60 to 70 rupees, right? So if at this point it was demanding 60 rupees conversion, it'll say, hey, look, I will, because of supply demand characteristic, there's less than what you want, so then I'm going to ask you for more of your rupees to give you the exact same dollar. So then the exchange rate goes up. So we now know when the exchange rate falls or depreciate and when it appreciates, right? And we saw that here in this example as well. So when it goes from 70 rupees to 80 rupees, from 70 to 80, or 80 to 70 is the opposite, it will be depreciating. So now we know how exchange rate changes based on supply demand of the asset that's needed. And so exchange rate depends on multiple things. We looked at the supply demand of what United States assets are needed by other people, but exchange rate depends on imports and exports as well, right? If United States starts to import more and more goods and services, it's going to start losing. Its exchange rate is going to start falling, right? But if it starts to export more, exchange rate starts to go up. Demand safety. So if the demand for United States dollar goes up, meaning people want to start buying more, the exchange rate will go down from 70 to 60, right? So it is all about supply and demand. It's all about supply and demand. What are your imports? What imports United States has? What export it does? What is the demand? And the other key piece is the interest rate. Interest rate also changes your exchange rate. So if, let's say, the central bank, the Federal Reserve, comes in and says, hey, I'm going to start buying the United States dollars. So then what happens? The United States dollars are bought, so the demand goes up. The supply remains fixed, and so the exchange rate increases, right? Because the dollars are removed from the system. So exchange rate changes drastically with the interest rate as well. And the central banks have a huge impact. When they increase the interest rate, all they're saying to the world is, say, hey, give me dollars, I will give you more of return because my interest rate is higher. So when the domestic interest rate goes up, my exchange rate goes up. Why? Because the demand for dollar will go up. When the Federal Reserve starts to provide more interest rate on a treasury which is backed by United States government, people will start pouring in. They'll be like, hey, this is safe. The demand for dollar goes up. When the demand for dollar goes up because of interest rate going up, the exchange rate goes up. Because everyone wants it. Everyone wants it. But then it'll start going up, right? As we saw from C to B. Similarly, the opposite, meaning if the foreign country's exchange rate goes up, foreign country's interest rate goes up, then my exchange rate will go down, right? It's the opposite action. It's basically that the foreign country is attracting more, saying, hey, I'm willing to pay you more interest, so their demand will go up. Similarly, if the US returns on assets, if the assets the United States now has is much more valuable, or it can provide more returns, or it is getting much better in terms of the future prospects, then the exchange rate will go up. You can buy less and less of the United States with that. So similarly, if exports go up, exchange rate goes up. And so there are so many such factors that impact exchange rate. That's what this is. How it moves up and how it moves down from A to B, and from C to B, how it moves up. And it depends on imports, depends on exports, depends on the safety feeling that people have. So this is what happened during the 2007-8 recession. People poured in afterwards. So the dollar exchange rate went up almost 20%. So given so many factors that impact the exchange rate, there is lots of volatility in the exchange rate, because a lot of future is now being bet on the dollar. So those future expectations being baked in impact the exchange rate, and so it's volatile. So if you were to summarize all of this, right, the exchange rate goes up and my imports go up, right? If my exchange rate goes up, right, let's say from 70 to 80, I can buy, as a United States citizen, I can buy things cheaper. So I'm going to buy more. So my imports will go up. If my imports go up, my inflation will go down, because now I can buy things in a competitive market. So if United States homegrown goods are expensive and they're getting expensive, the prices are going up, the inflation is going up, but I'm going to stop buying it. I'm going to go buy from outside. And so those prices then has to go down, so inflation goes down. So if exchange rate goes up, the opposite happens to exports, right? Because my currency is stronger, people will not be, they'll have to shell out more money. Initially they were shelling out 70, now they have to shell out 80 rupees for the same dollar, so my exports will go down, the demand for my goods will go down. So when my export goes down, my net exports goes down. When my net export goes down, my output goes down. Remember this piece? We had this equation y equals c plus I plus g plus nx, right? From the previous videos. So if nx goes down, my export goes down, my output goes down, because they're on this equation. Similarly, so now when my exchange rate is going up, right? What can the country central bank do? What does the country's central bank can do? They can reduce the interest rate, which will have an opposite effect. When you reduce the interest rate, people will stop putting more dollars because they are getting less return. So the demand for my dollars will go down. When the demand for my dollar goes down, my exchange rate goes down. So you can balance the exchange rate going up and down by monetary policy, which is this piece. And this is what happens based on how your country is performing, based on consumer demand, based on investment, based on exports, imports, government spending. That's what this is, your fiscal policy, as to how your country is doing overall and what the imports, exports is. And this could be monetary policy. And so they are joined to the hip by this exchange rate fluctuation, because this is important. If you don't take care of your exchange rates, you could get a lot of your industries out of business, because they can stop being competitive in the international market. So it's very important for central banks to play a huge role in monitoring these fluctuations. So a lot of times central banks do come in and they do these things, right? They bump up exchange rates and then they buy those currencies, and vice versa. They can sell and then the exchange rate goes down. So there's this policy trilemma wherein there are these three pillars: fixed exchange rate, free capital mobility, and independent monetary policy. You can pick two of these three, but you cannot pick all three. Let's say China. China has picked fixed exchange rate regime. This was until 2005 though. Now they have started pegging, which basically, so there are three ways: fixed, floating, and managed. So if it's a fixed exchange rate, it's just fixed, it doesn't change. Floating is that it keeps changing based on supply and demand. And managed is like the central bank can come in at some points to buy or sell currencies and then change the interest rate and then change the exchange rate. So fixed exchange rate, if you pick that, then you can either pick independent monetary policy, where you can say, hey, I'm going to print more money, I'm going to change my interest rate, or you can pick the capital mobility, but you cannot pick both. So in China, what they decided was like, hey, we'll have our own monetary policy and we'll do our own fixed exchange rate. United States picked the other two. It's like, hey, we want free capital mobility and we want independent monetary policy, but they gave up the fixed exchange rate. It's supply and demand. And Hong Kong did the other way. They picked fixed exchange rate and they pegged their currency, which pegging is basically saying, I'm going to anchor my currency to a strong economy, and in this case they picked United States. And so whatever United States does in terms of monetary policy just inherits that. So there are pros and cons to pegging. If a emerging economy pegs its currency to a developed economy, the benefit that they get is inflation is going to be in control because they will now have goods and services being sold at the international market level prices. But at the same time, they lose control of the monetary policy because they now all of a sudden cannot respond to, let's say, if there's lots of unemployment, if the growth slows down, they cannot pump in money because now they are dependent on whatever the parent country does in terms of monetary policy. So those are the pros and cons of pegging or not pegging. Emerging markets become very tricky, and there is a really interesting case on how Argentina peso, how they got inflation under control, but eventually because of pegging they had a huge inability to respond to money taken out from their banks, which required them to take loan from IMF, and eventually it led to the fall of peso in a pretty major way. So it's very tricky for you to, as an emerging market, to just peg, because the benefit is that you don't have to have an advanced institution like the Federal Reserve, but at the same time you can have benefits of inflation, but at the same time you cannot control and react to local shocks in the economy. So we learned a lot of things, but the key thing to remember is that interest rate has a negative impact, inverse impact, right? So interest rate, actually a direct impact. If you reduce your interest rate, your exchange rate goes down. If you increase your interest rate, exchange rate goes up. Imports and exports, how it's related to exchange rate. This is important. This is the crux of it. And how central banks, what are the factors that change exchange rate is important. And we saw how the currency appreciates or depreciates. In this case, it's appreciating and depreciating, and how it becomes stronger or weaker, and how it tries to move to the equilibrium, and it does that by changing the exchange rate. All right, so exchange rates and international economic policy. Thanks.